Hello and welcome. In this video, we are looking at a statement of cash flow question called Plethora PLC. We'll read through the requirements first, and then we'll look at the information that is given to us. Prepare statement of cash flows for the year ended 31st December 2018. That's requirement one. And the second one is that we need to make some written comments about the company's liquidity position by looking at the statement of cash flow that we are going to create. And the information given to us contains a typical statement of profit or loss. You can see typical items like sales, cost of sales, gross profit, operating costs, operating profit, finance cost, profit before tax, tax and profit for the year. And then we have been given 2 years worth of statement of financial position, 2017 and 2018. And that's for the comparison. We can see how the assets, liability and equity are changing. Right? And so that when we prepare statement of cash flow, we can find the difference with regard to how much cash did we generate through assets or spent on assets, or how much liabilities we settled, or how much borrowing we made, how many shares we issued for cash, so on and so forth. Okay, so we can see non-current assets, the costs are increasing, depreciation is increasing, but carrying value is decreasing. So it would be interesting to find out what is going on there. Current assets, we can see inventory, trade receivables, both are increasing. There is a tax receivable from the authorities, which is also increasing. Bank is decreasing. Now, let me clarify. For the statement of cash flow, the cash equals to cash on hand, cash at bank, which is the current account of the business, plus any type of cash equivalents. Okay, so the cash equivalents are the short-term, highly liquid investments, which can be readily turned into cash. Okay, if the company needs it. So we are talking about a very short-term, 30-day government bond, for example. Okay, so we want to analyze how this cash and cash equivalent changed from a certain amount last year to whatever we have this year. In this question, the only type of cash or cash equivalents we have is this balance here. Bank. So we want to see how the balance of 224,000 last year changed to 292,000 this year. What changes took place? What cash flows came in? What cash outflows took place? Okay, so that's what we'll be analyzing. Equity section contains share capital. We can see it is increasing. Share premium is increasing. Safe to assume, in an ideal situation, if there is nothing else is taking place, then probably company is issuing shares for cash at premium. Retained earnings are increasing, so obviously company has made profit, paid some dividend. Non-current liabilities are decreasing. Interesting. So they are paying off the loans. Current liabilities, you can see trade payables are increasing. Taxation is also increasing. So that's a tax is a liability. Some additional notes, which is first one is included in the cost of sales is depreciation charge for the year of £472,000. So the company incurred the depreciation cost of this much. During the year, company disposed of some plant at a loss of £72,000. So the company sold some plant and made a loss of £72,000, but we don't really know how much it was sold for, so we need to find out. That is an important item that needs to go in the statement of cash flow, the cash generated from sale of the plant. Okay, number two is the company replaced the disposed plant with a new one. Okay, so they bought a new one, which it purchased for cash. The cost of the new plant was $360,000. Good, so we know how much in terms of cash company is spending on purchase of a new plant. The last one, the company paid interim dividend of $264,000. Great. So all we know, that's all we know. Now, can we create a statement of cash flow based on this? Yes, we can. When we create the statement of cash flow, we need to keep in mind the objective of creating statement of cash flow, which is to divide the cash flows in three distinct categories. We want to find out, first of all, how much cash is the company generating through their regular operating activities. Second is how much cash we're spending on our investment activities. All right, so buying or selling non-current assets, how much cash we are spending on it. We want to see cash outflow from the activity. And the third category is the financing activities. So we want to find out if they are buying assets, right? How they're funding that, how they're funding their long-term projects. Are they issuing shares? Are they borrowing money, or how much, if any, if they're settling any liabilities during the year, long-term liabilities. So that's what we want to find out through statement of cash flow. And when if we create a successful cash flow, that should be able to enable us to analyze the difference between these two balances. So let's get cracking. Okay, I'm using Excel to create it. You can use anything. So we'll probably need 3 columns. Yeah, let's use 3 columns approach, and we'll give it a title first. Statement of cash flows for the year ended on 31st December 2018. Great. And the first column is going to be for the details, and 2 more columns for the pounds. We are going to be working in thousands, by the way. So rounding up, stripping off plus 3 zeros. Okay. So the very first category of the statement of cash flow is going to be the operating activities. So we'll start with operating activities. I'm not going to write in full, just kind of giving a title that it is an operating activities. Right, so what do we have in operating activities? Remember, we are using indirect method. So what we want to do is turn this the profit given in the statement of profit or loss into cash profit. So we're going to be working backwards. So we'll start with profit before tax, and then remove all the non-cash accruals based item, or the items which do not really belong to the operating activities of the business. Okay, so we'll start with profit before tax. We'll start with that. And profit before tax was 1,568. Okay, that's great. And let's put commas everywhere necessary. Okay, and round up the zeros. Okay, now the typical non-cash items that you would find in the statement of profit or loss. The very first item comes to mind is the depreciation. So we're going to add back depreciation. We are working backwards, right? So we want to remove any expenditure which is non-cash. In order to remove it, because you're working backwards, you need to add it back to the profit that you did have after deducting that item. So the note number 1 says, let's put it in the brackets here, it's note 1, depreciation for the year is 72. Okay, so that's great. Anything else? Yes. When you have a statement of profit or loss, you record any kind of profit or loss that you have incurred on the sale of non-current assets. Typically speaking, it is not an operating activity item, so we need to remove it. So in this case, note 1 also says that there is a loss on disposal of non-current asset. Note 1, and because it's a loss, it's an expense, we are going to add it back. Anything else? Yes, we do have something else called finance cost. Now, finance cost is coming from statement of profit or loss. It's 112. Okay. Now, the reason why we are removing it is because it could be on accruals basis, right? So, in other words, that you might have charged the finance cost. You have charged the finance cost to statement of profit or loss, but it is not necessary that you have paid the same finance cost in the year, right? You might have paid more, you might have paid less. So we're going to remove it from here and then reintroduce it at a later point in cash terms. So because it is on accruals basis, we're going to be removing it from here. So 112. Okay. So once you have adjusted all the non-cash accruals based all the items which do not belong to the operating category, we are not quite done yet with the operating activities, because we still want to adjust something called working capital adjustments. Okay, because during the year, the items that go in statement of profit or loss, like sales, purchases, okay, those kind of items could be done on cash, could be done on the credit basis. Because we are working using indirect method, we want to look at the related working capital items from the statement of financial position and see what is going on there. So for example, inventory, which is related to purchases, right? So last year we had stock worth of 80, and this year we had stock worth of 96,000, which means that we have spent more on inventory during this year, worth of £16,000, and that cash is stuck in that stock, right? It is not free, so you have spent more compared to last year. After all the trading that took place during the year, or purchases which you then have sold, that has been realized, but there's this extra 16,000 sitting in the stock which has not been turned into cash. Okay, so there is an increase in terms of stock. So we can say there is an increase in inventory. Okay, and this increase is actually not good for the cash flow. What it does is actually reduces your cash balance. It actually affects negatively. So this 16 will introduce it as a negative figure. Okay, then we are going to apply the same approach to receivables. We know that there is an increase in receivables. Just need to find out how much. So increase in trade receivables, again they increase by 64. Same logic is applied as we applied to inventory. Compared to last year, there are more receivables. More cash is with the receivables rather than being with you. Okay, so there is further investment in working capital, so it affects negatively to your cash balance. So what we'll do is remove again this 64 from our operating activities. That brings the cash down. Okay, and the third item in the working capital is payables, and we know there is again increase. So all we need to do is just scroll down to the trade payables, and we can see there is an increase of 24. Now, interestingly, when the payables increase or the current liabilities increase, it's actually good for the cash position. You might ask why. It's a legitimate question. It may not be good for the relationship with the supplier, but not paying them means that you're retaining more cash. Okay, so you will have to settle later in the future, but for this year you have retained more cash. This year we have retained £24,000 more compared to last year, which is actually good for the cash flow. So I'm going to introduce it as a positive item. So now we have finished working backwards. What we'll find, we have already finished working backwards, but we have already also dealt with the working capital. So if I add up this section up to now, we can call it the cash generated from operations. Okay, we can call it cash generated from operations. Great. Okay, so we are not quite done with the operating activities yet. In order to find the net cash profit, okay, the cash that we generated through our regular buying and selling, manufacturing and selling, or providing services, whatever we are doing, we need to deduct two more items from here to find that final cash surplus or deficit, whatever it is. So those items are, remember finance cost. Earlier we added back, yeah. Now we are going to reintroduce it. And the other one is tax paid. Okay, that's when in statement of profit or loss you will find the profit for the year, the final profit. In here you will find the cash flow from operating activities. Okay, now in this case we do not have any opening or closing balances for finance costs in the current liabilities, which means, okay, let's pick the closing balance of finance costs. If there was a closing balance of finance cost, then we can say that whatever we charge in the statement of profit or loss is not what we pay during the year. We have something left to be paid in the following year. So in this case, our finance cost is 112. Yeah, that's the expense for this year. If there was a closing balance sitting in the 2018 column of say 12, okay, that would mean that you still have to pay those 12,000, but that's going to be in the future next year. In this year, you have settled around £100,000 worth of finance cost liability. So in this particular scenario, we don't have opening or closing balances. So it is safe to say that whatever we have charged in the income statement is what we have really paid. So I'm going to deduct 112 from here. Now for tax, it's going to be different, okay? Because what we have for tax is some opening and closing balances. So we know that in the income statement we have charged 196. It's hardly the case when whatever you charge in the accounts is what you pay, and plus you pay immediately. So you pay later in the future. We want to find out how much tax we paid during the year. And we do have opening and closing balances for the tax. So we have some tax assets, yeah, and we have some tax liabilities. So what we'll do is we'll do a little working. Okay, we'll do a little working for tax. So if you're using pen and paper, you can leave the first page where you're creating the statement of cash flow. Go to the next page and do a little working for tax. So I'm going to call it the workings here. And the first working one will be tax paid. And for that, I'll need the opening balance, and we know what the opening balance is were. So the tax liability was 344 and tax asset was 32. So I'm going to net off the tax asset from tax liability, and that will give me 312. Let's put a pound sign on the top so we know what's going on. It's in pounds, right? So at the start of the year, you had a net tax liability of 312, which you should have settled in this year. Plus there was tax charge recorded in statement of profit or loss, SPL, of 496. Okay, so we are actually creating T account. It doesn't look like T account, but it is a T account. It's a kind of vertical T account. So if I do a little total here of how much we should have settled during the year, let's call it subtotal. So including opening balance and charge for the year, by the year end, we should have settled £808,000 worth of tax. Was that the case? Not really, because we have some closing balances. And the closing balance is 408, this which is the tax liability, and there was a tax asset of 40, so net off was 368. Okay, so can you see, this is, subtotal was 808, this is what we should have settled, however we did not, but we did pay some of it. Closing balance ended up being 368. So how much did we really pay? If we take the difference between these two, 808 and this 368, we can find how much tax we really paid. Got it? Let's go through it one more time. So what was our opening balance? In this case, we have a liability and an asset. Asset is netted off from the liability. So 312,000 is what we were supposed to settle in this year in terms of tax. Plus there are further tax charges of 496, which is coming from statement profit or loss. By the year end, we should have settled 808,000. However, we did not settle all of it because otherwise we won't have the closing balance. In this case, the closing balance, the year-end liability for 2018 was 408 minus tax asset of 40. That means total net was 368. So if I take away that from how much we should have paid, I can find how much we did pay. Yeah. So let's use that figure, which is working one. All right, and that is minus 414. Good. So we can now do a little working here, adding up. So all these figures, and we can find how much cash we generated from operating activities. So we can call it cash generated from operating activities. Okay. Now let's compare that with the profit for the year. The profit for the year was 1,072, but our actual cash profit was 1,616. Brilliant. More than our accounting profit. In terms of operating activities, we are doing very well. Okay. Now, next one is investing activities. Okay. And investing activities, primarily, we want to find out how much cash we are spending on the purchase of assets, non-current assets, how much cash we are generating through sale of non-current assets, and what is the kind of any investment income. If you have made long-term investments, how much income they have generated through that. Right. So we know from the question, note number 2, I guess. Yes. Note number 2 says we bought some plant for 360 for cash. So let's start with that. So purchase of non-current asset for cash. Okay, and last put it in the middle column in 360 negative because we are spending money. Then we also want to find out how much cash we generated. So let's say proceeds from sale of non-current asset. Assets. Right. Now this is going to be a bit tricky because we know that we made a loss on the sale, but we don't know how much cash we generated. We can find out. If we have the carrying value of the plant that we sold, then we can deduct this loss from it and we can find out how much cash we got, right? So let's do a little working for that. Again, just underneath the text working, we'll call it working 2, and this is proceeds from sale of non-current assets. So we'll take the same approach like we did for the tax paid. We'll start with the opening balance of non-current assets, make all the adjustments that are supposed to go in that account, and what hopefully will be left with is the carrying value of the plant that we sold. So let's start with the opening balance. Okay, coming from the question, and please be careful. Now there are 2 ways you can do it. You can create vertical T account for the cost. You can create a vertical T account for accumulated depreciation, and that's how then you take the difference that you have found in both accounts. Okay, take away the accumulated depreciation from the difference in the cost, which is going to be the disposal, and the figure that you will get will be the carrying value of the plant that you sold. We're going to take a shortcut. All right, we're going to merge these 2 accounts and create one account. So in other words, we are going to work in carrying values all the way through. So the opening balance, you're going to be using carrying value, because when you net off the accumulated depreciation from the cost, is what you get is carrying value. So it's safe to work in this particular scenario in carrying values. So cost minus accumulated depreciation is the carrying value. So the carrying value in this case, starting with 5,344. Okay. And then we are going to deduct items. So what kind of items affect the non-current assets? What kind of changes that can take place during the year? So things like purchase of non-current asset. There was a purchase of plant, we know that will make the balance go up. There was depreciation, okay, working in kind of abbreviations. Depreciation charge for the year of 472, that will make the carrying value go down. I don't suppose in the question we have any revaluation or lease-based assets, so it is safe to do the subtotal now. Add it up. Let's add it up. Okay, let's do subtotal. Comparing it with the closing balance carrying value. Actually, will be fine. Closing balance carrying value 5,000. This one. 5,001. Okay, and the difference that we'll find, okay, is disposal. Okay, proceeds from disposal. So we can say this proceeds. Disposal of non-current asset. Now, not quite done yet, because if you have noticed, this is just oops, sorry, these are not proceeds. These are the disposal. Sorry, disposal at carrying value. Right? We haven't quite found the proceeds yet. Now, in order to find proceeds, as I said earlier on, we need the disposal carrying value, which is 120, and from here we are going to deduct the loss. Okay, and the loss we know from the question was 72,000. So if we deduct 72, what we'll find now is that's the cash proceeds. Okay, so now we can say this is proceeds from the sale of non-current asset. Okay, let me go through this working one more time. So we want to look for, we are looking for the disposal, okay, and how much cash received from the disposal. And for that, we had the loss, but we needed to find the carrying value, so we can deduct the loss from it to find the cash. So we start with the opening balance at the carrying value of the asset, and then made the adjustments with all the items that affected the non-current asset account, right, or PPE account in the year. So we purchased the plant, which we added. We had a depreciation charge that we deducted. That's how we found the subtotal. Now, in an ideal world, if nothing else took place during the year, that should be our closing balance, right? But the closing balance was different. That means that something else happened during the year, and then we found the disposal because the closing balance was less than the subtotal. So we found the carrying value of the disposal. We deducted the loss from it and found the proceeds from the sale of non-current asset. So let's call it working 2 and then add 48 to that. Add up. Now we don't have any investment income in the question, so we can do the subtotal of these two items, and we can call it cash used in investing activities. Okay. Cash used in investing activities. So spending money on investment, which is good. Now, third category is financing. Okay, financing activities. We want to see how much cash we generated from the sale of shares. So let's start with proceeds from issue of ordinary shares. We know that we are issuing some shares. So in order to find that, we just need to take the difference between the balances of these two accounts, ordinary share capital and share premium. So when you issue shares, you issue them at premium. So last year, the ordinary share capital was 1360, which has increased to 1440. Share premium was 96, and share premium went up to 144, which means that we issue some shares because there was nothing else taking place during the year which we were aware of. So proceeds from issue of ordinary shares. If I compare these two accounts, yeah, add up opening balances of ordinary share capital and share premium, and add up these two and take a difference, I find, how much do I find? 128. Okay, so that's the cash received. We also have repayment of long-term borrowings. We know that it has gone down. Yeah, loan notes has gone down from 2,000 to 800. So we have paid off, so negative 1,200. Lastly, we also have some dividend that we paid. In the question, we have been told that the question says that the company paid interim dividend of 264,000. So let's delete that. Minus 264. And then we can do the adding up again of these three items. And we'll find, oops, it's negative. Wow, okay. So we can say cash used in financing activities. So now we have cash flows from all three activities. The operating activity generated positive cash flow, and the last two generated negative cash flows. So what if we add up the whole statement of cash flow? What do we get? The total that we get is called net cash increase, or in this case will be decrease, okay, in cash and cash equivalents. Okay, so let's do some adding up here and see if we are right or not. Oops, it's not doing right thing. Okay, let's see if we are getting, yeah, we get negative 30, so there is a decrease in the cash. And if you remember, I said at the start that we're actually trying to analyze the difference between these two balances of bank. That's the cash. So how this 224 turned into 192? And we have actually done the analysis through the statement of cash flow. So now the question is, if I take the difference between those two balances, do I get negative 32? I should get negative 32, shouldn't I? So let's do cash and cash equivalents, opening balance, and cash equivalents, closing balance. Okay, and opening balance was 224, closing balance is 192. If I take the difference between two, yeah, I should get negative 32, which I do. Okay, so this is a little trick for the exam as well. If you don't want to add up the whole statement of cash flow because you made a mistake somewhere, you can simply take the difference between the opening and closing balances of cash and cash equivalents. So if you have more than one type of cash item, you need to add up. You might have cash on hand, cash bank, you might have some short-term high liquid investments. If you add them up and take the opening balance and compare it with the closing, the difference you will get is the total of the statement of cash flow. Okay, so yeah, so that's our statement of cash flow. Now let's do a bit of analysis, because that's what the question is asking us to do. Make written comments about the liquidity position of Plethora PLC. We won't write it, but let's talk about it, what's going on. So the first observation is that our opening balance of 224,000 cash balance has turned into 192. So there is a decrease in the net cash during the year, right, of 32. How did that happen? What were the contributing factor? So first we divert our attention to the operating activities. Our statement of profit and loss had a healthy profit of 1,072. But when we prepared the statement of cash flow, that turned into a positive, even higher cash profit of 1.6 million, right, or 1616. Why? Why did that happen? Right? Well, we can see that it's because of these few items listed over here. We had depreciation, which is a non-cash item. We didn't really spend that money during the year. Okay, we spent money on the asset when we purchased it in the past, so we had it back. So that wasn't the cash flow, so we had it back, and that increased our operating cash flow. Loss on disposal of non-current asset is not really loss on disposal. Oops. Sorry, I think it's switched. So loss on disposal. I'm sorry. The depreciation was 472, and the loss was 72. Okay, let's switch it. So the depreciation was 400, it's a huge balance. So we remove that. It's not non-cash. It is not cash. Loss on disposal also not an operating activity. All right, so we removed it. So those were the key contributing factor, turning the the cash into the accounting profit into cash. And there was a bit of increase in payables as well, which quite helped. So operating cash profit looks really healthy. Now we divert our attention to investing activities. What is going on over here? We have purchased a non-current asset worth of £360,000, but is that sufficient compared to the amount of assets that are going out of the business? Remember, we sold a plant with a carrying value of 120,000. Okay, and that's out. That's probably what we are replacing. But in addition to that, we have assets worth of 472,000 wearing off during the year. The depreciation. Who is going to replace that? Okay, so there is a gap between the assets becoming unusable, and it's a negative cash gap, and the assets that are replacing them. So there's a big gap. So that's a bit of concern for the business. If they don't invest in the assets at the same rate at which the assets are going out of the business, they will soon struggle in terms of survival because they won't have non-current assets to run the business. All right. So how are they funding this purchase of non-current asset? Bit of cash, or perhaps all of it, is coming from the operating activities. They have a good cash operating profit, and perhaps a bit of it is coming from the proceeds of the share issue as well during the year. All right. But when I look at the repayment of long-term borrowing, it makes me think that the company is trying to be more self-reliant. They're trying to reduce gearing. All right. So it is actually a plus in favor of the company. They're actually trying to reduce that gearing, reduce the debt, because it will end up eating up our profit through the interest. So they're using money from the pocket, the cash that's generated from the operations, to pay off the loans, which is great. And they have also paid some dividends, so they're keeping their shareholders happy. So in a nutshell, it looks like the company is not doing too bad in terms of operations of the business, but they need to concentrate on the investment part, the non-current assets part, because at this rate they will find it difficult to survive financing activities that are doing great, that are paying off the loan. So in a nutshell, we have said where they need to improve and where they are doing good. Okay, great. So I hope you enjoyed the video, and see you next time.